What's up, Flow Trader fans? My name is Mike Sharp. This is Sharp Investing, and Flow Traders has released quarter one results. But the big news off the top is that Mike Keuhnel, the CEO, is leaving, and I suspect that this is the reason the stock had a nice little crash as soon as the report came out. Now, Mike Keuhnel has been a great CEO, and so this is definitely bad news that he's leaving. He created a new direction for the business. He got them to be a more diversified business. They used to just be in Europe doing ETPs in Europe, but now they're in North America. They have a presence in North America, and they have a growing presence in Asia as well that's actually doing quite well. He also had the great move where he changed the capital allocation strategy away and removed the dividends and basically started stacking the trading income. Now, if you don't know anything about this business, if this is the first video you're watching, I would suggest going back, maybe listening to the first one. I'm not going to explain the business in detail. And also maybe check out the one, I think I did a video in August. It's titled like Good News, and that's when they changed the capital allocation strategy last year. So maybe go back and check those out. But the short form is they're a market maker. They're headquartered in Europe, but they have presence in those three regions I mentioned, and they are one of the bigger fish. And basically, they make money in all environments. Like, I have not seen a down quarter for them. There was one that was close to losing money, but basically, they make money in all markets because they're direction agnostic on the market. But they do make more money when there's chaos, when the VIX spikes, when the move index spikes for fixed income, or when crypto gets really excited. I should also mention that his diversification plan included asset diversification, right? They used to just be in equities, now fixed income, FX, crypto, and they're branching out to a lot of adjacent businesses. So he's leaving. Bad news. The good news for me is that I don't think he's necessary for them to keep just making money. He's more of my view on it is that he's more of a direction setter, put the right people in place, set the direction for the business, which has been excellent. So the risk here is that we end up with a CEO that changes something. So that's what we're going to look for. Now, the markets hate uncertainty, so it's understandable that it's sold off. But I think this business is a pretty good deal, right? So if we just do a few calculations based on the quarter one stuff. So quarter one, not a super interesting quarter. They made good money in it, but there's not a huge amount going on here. I'll just try and go through some of the stuff quickly. I tend not to be that good at being quick at these videos, though. So trading income, 135 million, and EPS at 84 cents. So that's down. The EPS is down about 21% from the first quarter. And that's, I think, in large part due to, well, there's two things going on, and they're both sort of crypto related. One is that quarter one last year had, pretty high margins because the Bitcoin ETFs came online, and there was a bit of a buying frenzy. And I think that revenue was pretty high margin for them, and that was basically just a one-off bonanza. So, and the other thing that's going on is there's a $10 million write-down, and he was talking about this because they had to pull it out on the income statement rather than just stuffing it into the trading income line. But basically, that's a non-cash expense. So if you look at the EBITDA number, it's basically flat year over year, 62.3 million versus 61.6 million last year. And that's maybe a better proxy for the cash flow of the business. So at 46%, still really profitable, very cash cow business. They just pump out cash, and then it goes right back into the trading income, trading capital, not trading income, trading capital. So, that's all nice. Now the margin's down a little bit. One thing I noticed here pretty quickly was that the fixed operating expenses was up quite a bit from last year. That was unexpected. up 15% from last year, and it looks like they're going to run it at about 200 million for this year. So I was like, well, what's going on? They don't actually, it's the system's set up, right? So I'm like, why are they actually hiring here? That's a pretty big burst of hiring. And what they were saying was they've actually started to hire specialists in the various divisions and the various segments of the business. So I believe that is a growth move as opposed to just a sort of administration expense improvement. So I wonder if that's going to actually lead to more growth in the future. I would hope so. So, I don't think Mike Keuhnel was the type to just waste money, and so I think there's probably some intention behind this move. I guess I would mention that in this quarter one, we all have the tariff stuff. We've had the huge meltdown at the beginning of April, and then a massive bounce back now. It is May 2nd, and everything seems like it's just V-bottomed off the bottom, which is weird because, every economic metric you look at, they're all going to be worse. So I'm a little confused as to what's going on, but I've been through enough stock cycles that I do know that sometimes the economy and the stock market don't go in the same direction, they diverge, right? So just be careful you're not marrying your view on the economy to your view on stocks, right? Because if sometimes people want to hide somewhere if they're afraid for the money, and stocks sometimes get inflows. There's other reasons for it. If the Fed starts cutting interest rates, you could see another spike like 2020 where everything was broken and the stocks just went straight up. Who knows, right? But I've digressed here. But what I was trying to get to was in quarter two, all of that tariff mess is not included in these results yet. So I think quarter two is going to look quite good. Now they said it's not going to be as good as the COVID mess, but that was just a total, once in a lifetime. I forget how many, I think they made €8 that year in earnings. So he said it's not that big, but it's big, right? So who knows what that means, but I do think we might see that the stock of this company moves up into quarter two earnings as the market realizes there's a pretty big report on the way. And who knows, it could even get better. We'll see what happens next with these tariffs. Okay, so if we look at the trading capital, back to trading capital, this is the one that we care about the most because the earnings are going to be all over the place. That's the way this company is. It's totally dependent on what the markets do and what the various markets do. So there's no way of predicting the earnings here. But if we look at the trading capital, it's been on a steady incline, and especially since they changed the capital allocation structure. So now they're over 800 million in trading capital. That's up 32% from last year. And keep in mind, that includes a dividend payout that they made last year, right? Because they didn't change that policy until halfway through the year. So without that, it would even be more growth in terms of the trading capital. Now, trading capital and shareholders' equity are about the same. So it's, if you're a book value investor, this is where you want to be looking. Now, I'm not a big asset investor. I don't really believe that's the way to value most businesses. But I think with this one is actually the exception to that rule for me, because their book value is directly related to their income earning capacity, right? So they take the trading capital, they reinvest it in new trades, and that creates income, right? So if we look at the return on equity for this quarter, it was 21%. That's a really good return on equity, especially on a sort of a medium quarter, right? It can go down, right? We've seen 6% in the past. In 2023, I think that was the low end. And then on the high end, you can see 2020, it was 101% return on equity. right? But they seem to land right around the 20% mark. And if you continue to have a 20% return on equity, that is a double in the return on or in the equity value and potentially the stock value, the market cap, every 3.5 years. Now, if we also marry that with their guidance, or not their guidance, their goals, this company's goals are to hit $1 billion in trading income in the medium term. They don't give a time frame on that, but I'm thinking that's like within 5 years of getting to $1 billion in trading income, which means the net income on that would probably be somewhere in the range of 30 to 35%, or 300 to 350 million, right? So if we take a look at current market cap 1.1 billion as of May 2nd versus potential of 350 million in net income, you're trading at a future a medium-term PE of about 3, right? So depends what you think those earnings are worth. My sort of ballpark is that I'm willing to pay about 1 peg for the earnings, right? So if you're getting 300 million in earnings times, and the growth rate is, let's say, 20%, because the return on equity is 20%, it could be worth upwards of 6 billion, right? Now that's just a real shot in the dark number, and this stock may never get that kind of valuation just because the earnings are lumpy and they're very hard to model, and you never know when the cash is coming. It always comes, but you never know when it's coming. So analysts don't like that. Investors don't like that because there's not clarity. So may never get there. May stay around the 10 times earnings multiple. But still, if it does that, you're still at 3 billion in, let's say, 5 years. Now, that's not a projection. This is not investment advice. These aren't like guaranteed outcomes. I'm just talking about the way I'm thinking about this as the potential upside. So I could see it, about a triple in 5 years. And I really sleep well with this stock. Like, I know that even if the world goes to shit, like this company is going to do well, right? It's the one stock in my portfolio that I think it may not get destroyed in a bear market collapse, right? And it's great to have that kind of. I love having that kind of uncorrelated stock, because if you haven't been through a real bear market, the problem with bear markets is the correlations in most stocks go to 1 and they all just go down. It doesn't matter if you have the best business in the world, it's probably going down. And it's probably going to go down pretty significantly. So this is just, it changes the return profile of the portfolio, and I really like it. Okay, so a couple of other notes here. One of the things that they said in the earnings call was that we are confident that such triple-digit net trading income will be a regular occurrence going forward. That is a really good statement. They're usually not that, they don't give that much guidance, but their confidence level sounds really high that this is not an anomaly, right? So 80 cents, running at a €3.20 annual clip right now, and 131 million in net trading income. They think that might be sort of normalized now. Also would say that the regions breakdown is quite interesting here, because a lot of the money came out of the US and went into the other 2 regions in Europe and Asia, and both of those regions did really well. Like, I'm particularly interested to see Asia at 44 million in net trading income, and that has grown quite a lot since they opened their office. Their last office there, I think it was in Shanghai. And they're now, it's more than 50% of the European income in Asia. So 44 million in Asia and 80 million in Europe. That's a good sign that they're not going to be so dependent on the European market going forward. So diversification is working. Initially, when I looked at the American one, I was like, oh, that looks bad, right? It just totally collapsed by 72%, but they explained that that's intentional. They're taking capital from the markets where they feel the return's not as high and funneling it towards the high return market. So that's what we want them to do. We want them to go after the highest margin revenue available in their buckets. So that's actually what we want. So the last thing here is, if we look at the sort of crash after the earnings of about €5, I think that's for me, that looks pretty juicy, right? If this came down even more, I might consider adding, because the business is totally fine. It's just churning over like expected. It's pumping out cash. It's operating as expected, and Mike leaving is not going to interrupt that. So I think this is potentially creating a buying opportunity. I haven't bought more yet, but I may, depending on where this lands. It seems like it's bouncing pretty quick though, right after, and I seem to have missed it so far. Last comment would be, I think now we just need to look at the CEO situation. We have to see who the new CEO is, and primarily what the plan is, right? Ideally, he says, let's just business as usual. Let's say the board hires somebody. They like the direction. They hire somebody who is just going to continue with this direction and maybe tweak it and try and improve it. Worst case scenario would be dividend comes back. They sort of like pull back and sort of start, they slow down on the growth levers. So that's my view. Good quarter. Bad news that Mike is leaving, but I still sleep really well with the stock, and I'm going to keep holding. Thanks for watching. We'll catch you in the next video.